preparing for financial emergencies. And most of you have heard, you know who I am, right? I taught Craig's, okay, so certified financial planner. And when we're looking at preparing for financial emergencies, the overview is many people face financial emergencies, but few have prepared adequately to prevent them from having a major impact on their personal finances. By helping people understand the types of financial emergencies and potential consequences of not being prepared, we will enable people to focus on the steps necessary to avoid hardships which can accompany the emergencies. So the webinar is going to cover the processes and products which can help people survive the various types of financial emergencies. Excuse me. So that is the overview. Again, Vicki had mentioned they're going to talk about budgeting in here. Some of the things are going to overlap a little bit. In my infinite wisdom, yesterday I did not have that. We didn't have that copied. I said, yeah, just go to email me. I'll get you a copy of this expense sheet. And then afterwards, Allison said, can I make a photocopy? Yeah. So we got photocopies of this. If you want, should I pass one? Do you guys want one?
I think I got it.
Oh, everybody, good. Fantastic. So that was definitely a good move, Allison. All right. So again, the objectives. Identify types of financial emergencies. Learn what can happen if you're not prepared. Explore ways to be prepared. Decrease stress levels and allow you to focus on your goals. So that's, preparing for emergencies. And on this little quote right here, before anything else, preparation is the key to success. Alexander Graham Bell said that. You've probably heard me in the last presentation. When you think something's true and it's not true, when do you want to know? Right away, so you don't keep doing the wrong thing. So that's kind of the gist of this. Be prepared. Types of financial emergencies. What are we talking about here? Job loss. You probably hadn't heard me talk about Two Rivers, where I grew up. Job loss is a big thing that you can try to prepare for it, but it's still, sometimes you're just caught out of the blue. Accidents or injury, obviously nobody knows that that's going to happen. Illness, disease, surgery, car, home repair, fire, flood, death of family members. Talk about fire or talk about flood. We got a lot of rain, when was it? End of August. And if you're not in a floodplain, which I'm not, I don't have to have health or flood insurance. So unless it's damage, if water gets in due to a bunch of rain, your homeowner's insurance is not going to cover that. You might have $20,000 of damage. And so that's something, can you really be prepared for that? Maybe. I mean, if you can stick away $20,000 or a good chunk in savings, more power to you. I know a lot of people that can't. The other option is, can you tap into your retirement plan? And we found out that you can. So in the 457B plan, there is a way, I don't know what you have to do, but you can get a loan if you had to. You don't ever want to do that if you can help it. It's not, let's just, fly by the seat of our pants knowing that you can take out a loan, but it's available, right, Allison, in the 457. I know Deborah had mentioned that. So I don't think the last time we presented that we talked about that. Or death of a family member. So just be prepared. Typical results of not being prepared. What can happen? Evictions, foreclosures, utility shutoff, collection actions, judgment, wage garnishments, bankruptcy, turning to payday loans. I think we mentioned that in the last one. That's something that you don't want to do if you can help it. Loan sharks. I mean, that's not on here, but obviously I don't know one. But I mean, that's, you don't want to have it come to this if you can help it. So just, again, I know most people don't have money coming out of their ears. There's too much too much money than they know what to do with. But as we talked about in the last session, if you look at your budget and you can figure out, here's what we have in discretionary income, let's stick some of that into savings where we have 3 to 6 months of our expenses in an emergency fund. Ways to be prepared. Create a budget and stick to it. Now, This thing that I passed around, you're going to see in here and on your sheet, and in the last one, this is very detailed. So if you have it in front of you, you can see all these housing and related expenses. You know, what jumps out at me, is the homeowner's insurance. You've got, home maintenance and repairs. There's always stuff that you should look at. Transportation expenses. It's broken down a little bit more. Lifestyle expenses, dining, taking out, and, you've got groceries. Groceries is down under the personal expenses. So if you look through these, it might jog your memory or pique your interest in, whoa, I forgot about this or I forgot about that. So this is just a little bit more detailed. Medical expenses are in this one. Taxes, federal and state taxes. How do you figure that out? Well, you just look at your last year's tax return. Line 44, I think, of the federal tells you what your federal income tax liability is. You can look at states. So when you think something's true and you know about it, now you can plan. Who was I talking to? One of you guys before. Whoa, we didn't really know what we were spending our money on. So create a budget and stick to it. Set up an emergency fund. We talked about that. Reduce or eliminate debt. Pay off those higher debts first. If you got a credit card that you have a 25% interest rate, you might want to clean that up as quick as possible. So maybe somebody in the family, husband, wife, gets a bonus at the end of the year. Not saying you do, but I mean, let's say somebody does get a bonus, or what we see, Vicki and I see, is at the end of the year you have a higher income tax refund. So you get an income tax refund. I've got clients that cannot save money to save their life. The forced savings plan for them is claiming zero on their W-4 so they have as much as possible withheld on their income taxes, because at the end of the year, they get that money back. That's the only way they can save money. So they get a $3,000 tax refund at the end of the year, and guess what? They pay off the credit card debt and maybe have some fun money. So set up an emergency fund. Easier than said than done. If that's what you have to do, just do whatever you can. Reduce or eliminate debt. In an ideal world, that would be easy, but sometimes we can't. It just happens. If you have, an emergency, a flood, you lose your job, how are you going to reduce or eliminate debt? You're not. You might have to take some on. You might have to take out a loan out of your retirement plan. Improve your credit score. We'll talk about that in a little bit, but that's important. Review insurance coverage. I know you guys have open enrollment every year. Make sure you take advantage of what the employer, the city of Appleton, is giving you. Why not? It's money on the table. Purchase disability insurance. Increase your 457B contributions, or look at doing that. Look at doing an outside IRA or Roth IRA. Now that I know, I just found out that you guys have the Roth option in the 457 plan. That's huge. Simple. You probably just go on the website, click, how do I want to contribute? Pre-tax, Roth. Does that sound about right? Okay, so I mean, that's typically what you can do, and do that, it comes right out of your paycheck. So that's ways to be prepared. Creating a budget. What is the benefit of this? It can help you change negative spending habits. I didn't realize we were spending this much on beer drinking on Friday and Saturday at the bar. Just kidding. I mean, that doesn't affect you guys probably, but so you can change your negative spending habits, helps you make expenses manageable, identify possibilities for saving money. We're spending too much here. Let's reposition this. Allows you to find ways to reduce debt. Helps you improve your credit, which is important. The example I use, I don't live out of my means. I don't think. I've got a house that I bought in 2003 in Green Bay that was $125,000. Okay, so I didn't have to take out that much in a loan, but let's just say it's 120, because I was trying to use today's numbers. Of that $120,000 loan at a pretty decent interest rate, I think I ran it at 4% on a 30-year loan. 30-year, that's $800 a month. Okay, I don't pay my property taxes in this, so this isn't including if you escrow. This isn't your property taxes. and this isn't your homeowner's insurance. So just $800 a month for pure mortgage. 800 times 12 months in a year times 30 years, that would be $288,000 that I'm paying for a $125,000 house. Why would I do that? Because I want to live in the house. I don't have 120 grand just to pay for that. Now, credit's important because let's say I couldn't get that lower interest rate. I had to pay a little bit more. Not even that much more in interest, 1.25% would change that to $900 a month. Okay, so $900 a month for 12 months in a year times 30 years, that's $324,000. That's an extra, almost $40,000 that I paid just because I had a little bit worse of a credit score. So manage your credit, that's important. It provides you peace of mind. Okay, we know what we're spending on, at least we know about it. Provides a cornerstone for achieving your financial goals. So budgeting, and just talking about credit really quick, somebody had asked about credit quality and credit score. So if I pay off a credit card, should I close it? You guys know you can do that, right? You can call the credit card and say, shut down my credit line. It might not make sense if you have another card that you're maxed out on. So let's say 2 examples. Let's say you've got a $2,000 credit line on a card and you just paid off. You had $200 that you owed on it, you just paid it off. So that $2,000 credit line, 0 of the credit's used. You've got another credit card that has a $3,000 credit line. On that, you've got a $2,000 balance that you're not going to pay off. Okay? So you've got $5,000 available credit. You're using $2,000 of it. If you pay off that one that had the $2,000 credit line because you just paid it off, that's gone. You call them, say, cancel it, I'm done. Now you've got $3,000 of credit available with a $2,000 credit balance. So now you're at 2/3 of available credit used. That's not going to be good. So that might be a reason it makes you feel good. We were sick of this thing. We just paid off our last. I'm going to close this thing down. I don't want to get any more trouble with it. You may want to keep it open just because it could have a lower your credit score. Does that make sense? All that rambling, hopefully you understood what I was trying to say. Budgeting. You probably saw this in the last class. Were most of you guys in here? So you saw the slide, you get it. Great. Well, is there anything there that, let me see if I have any notes on it. I don't think so. You start with the income, deduct your fixed expenses and your variable expenses, allocate for discretionary spending, which you probably do. If you start, most people when they look at their budget, they already know from their paycheck, every paycheck, whether you're paid weekly, bi-weekly, 26 times a year, 24 times a year, on that paycheck, you're going to see if there's a contribution to your retirement plan, the 457. So that's already going to be on there. So when it says allocate funds for discretionary spending, I'm already assuming that you're sticking money into your 401k or doing some, you can do as little as $50 a month into a Roth IRA outside of the employer plan. That's assuming you have that in there. Then, of that money left over, if there is money left over, try to build up your savings account. I mean, it's not, we don't see any revenue from that, but it's important for clients, every one of them, you got to have that emergency fund. I'd keep it right at the bank. Don't try to go through me. Craig, I want to get a little bit more than 1%. Yeah, we can talk about your non-emergency funds to do that, certainly, but keep that 3 to 6 months at the bank. Does that make sense? I know my broker-dealer would be like, are you nuts? Sell them a mutual fund. But it still makes more sense to do it that way. Set up an emergency fund. I'll go through it, but I just have one point on here. Most people don't have an emergency fund. It is key to start one as soon as possible. It eliminates the need to borrow to survive emergencies, unexpected events. The goal is 3 to 6 months of living expenses. We talked about in retirement, you'd probably want to have 3 years. So if your ExxonMobil stock goes down, don't sell it when it's down. Give yourself 3 years for it to come back. Regularly monthly contributions, that should be included in your budget, which we just talked about IRAs. Down here, keep funds outside of your regular accounts safe and liquid. Now, what do they mean by this? I just know what I would do. And so if you're in your household, you've got your budget, okay? You've got a savings account that is probably jointly owned, maybe even a joint checking account. I've seen people that have their own individual checking accounts. Craig, I want to buy fishing equipment, and I'm going to do it. I don't want my spouse to not let me, whether it's the husband or the wife. You know, there's a lot of women fisher people. I'm digging myself a hole, sorry. Keep funds outside of your regular account. So in that situation, your emergency fund shouldn't be the savings account that one of you guys might tap into just for the heck of it. Maybe move that into a money market that, you know what, no matter what, we aren't going to touch this thing. This is our true emergency bucket that I don't want to use to go out to eat on or buy the kids, you know, Christmas gifts. Now, if you decide to do that, that's fine, but what they're trying to say is keep that completely separated. Create and implement a debt reduction strategy. You know, what they didn't say in the last presentation, and it's obvious, I should have said, first, stop adding to existing debt if you can help it. You know what I mean? Always pay at least the minimum due on all debt obligations so they don't ding-dong you with fees. Those fees don't do anything. Create aggressive plan to reduce your debt. Pay debt from the highest interest rate to the lowest interest rate. You know, I don't know if I say this in here, but I'm going to say it now. Just think of the federal government. You know, they've got debt. They lend us money, lend other countries money in the form of bonds so they can spend money on roads, pay Social Security and other things. So when you look at that debt, interest on debt doesn't build roads. It just goes to pay the interest, right? So when the 10-year Treasury is ticking up from 2.25% to now 3.2%, the federal government is going to have more debt burden to pay, which isn't going to be able to be used for income tax reductions, to be used to build roads and bridges. So that we can kind of equate to our own personal situations. Pay off your debt from the highest interest rate to the lowest. We talked about that last. It just makes sense. Interest, we don't get any brownie points for paying higher interest rates. So look for opportunities to lower interest rates. Lowering interest costs will allow you to save for other goals because you have less money earmarked just for that obligation. Reducing debt can help during a financial emergency. Meaning, okay, we've taken down our debt. Now, because we've reduced it, our credit might be a little bit better. Now we got to get a loan because we lost our job. So reducing debt can help during a financial emergency. Don't be afraid to ask for help. Review and improve your credit score. So this kind of goes over, this chart shows what affects your credit score in a broad sense. So the biggest thing, okay, good. I almost forgot I had the microphone on. 35% is due to payment history. Pay them on time. Pay a little bit more if you can. Amounts owed is 30%. So that's what I was talking about before. Amounts owed compared to available credit. If you've borrowed or used up $3,000 of your $5,000 available credit, that doesn't look great. You don't want to have zero. Ideally, you'd be at about 20%. So if you have over that 20, it starts getting to act as a negative on your credit score. Above 50, it's going to lower your credit rating. So payment history, amounts owed, length of credit history. If you've never had a credit card before, you're not going to have good credit. So those kids that are just, or young individuals that are just, graduating high school or college, maybe have them, when they buy a car, put the car in their name, or at least when they're 18, have them make the payments so they can establish a credit history. New credit. You got, okay, I found out that I used to be paying, we always pay our credit cards on time, and what I would do, I'm taking on more credit card debt, and I would just go from a 0% card to this 0% card to this 0% card. It's been working for the last 3 years, but now credit is starting to tighten. I'm not getting in the mail anymore these opportunities to do a 0% balance transfer. There's got to be somebody out there that'll do it. I'm going to go and Google, will this company do it? Will this Capital One do it? No. So when you're looking at new credit and shopping around and having them do an actual inquiry, that's going to have a negative impact. But if you get a new card, so that's one side of the story. But if you get an actual new card, get a brand new Cabela's card, and now you've got, you just pay off your balance every month. That new credit will actually help you because you're not above that 20% level. And types of credit used. So that's what impacts your credit score. So influences interest rates on loan. The better the credit score, the better the loan rates. Can impact your options in an emergency. This is something I didn't know about on one of them, I'll tell you. So it may affect your insurance. Did you guys know that if you're shopping out for auto or home insurance, now they look at your credit? I mean, I don't know. I've got a great guy. His actual name is Stu Ninnebuck, and he works at Liberty Mutual. I didn't know his office was right down here. He's got an office actually in Green Bay too. But I don't think I want some Joe Blow that I don't know. If I'm shopping out just to get a different auto quote, I don't want them knowing my credit history. So I think that's kind of intrusive. But employment, this makes sense to me. More employers are pulling credit reports before extending offers. Probably, the better your credit, typically the theory I'm guessing is the more stable you're going to be, meaning you'll be here. We don't want to spend the expense of training you and hiring you to have you move to the 6 months from now to the next employer. This is important for landlords. Most landlords review credit reports before approving leases. Are they going to be able to pay the rent? Right?
Can I just interrupt?
Yeah.
Small fun fact. You mentioned Stu at Liberty Mutual.
You know him?
Well, we have a deal with Liberty Mutual Insurance, and Stu is our contact there. So when you mentioned
good.
him, so just an FYI,
I'm spilling all over myself.
he gives you for free quotes for auto and home insurance. You get discounts with the city. So that's Stu.
Plus, I go through Stu, and that guy works pretty hard.
Fun fact.
And, why overpay if you don't have to? Ninnebuck. Oh, not talking to me. Credit reports are available online for free. So the score may cost you if you have a poor or a lower score, but the online accounts or the online reports are available. This annual credit report, and again, this is in your packet, .com, puts all three of them, gives you all three credit reports annually.
Also, a question on
Yeah.
that, because so does it affect your credit if you're checking your credit report?
Credit Karma says no. So as long as there's not a hard inquiry, meaning you're not applying for credit somewhere. So if you go to Kohl's, or where do I go? Fleet Farm. Hey, do you want to apply for Fleet Farm? If you applied for a Fleet Farm card, yes, that will be a hard inquiry.
Okay.
But according to Credit Karma, that doesn't affect your credit. So, and that's a good thing. Why should it? I want to know what my credit is. Why do I have to get ding-dong just because I'm trying to figure out what's going on? Review your insurance coverage. So I got some notes on this. Property and casualty insurance. That's typically your homeowners, your auto insurance, boat insurance, umbrella insurance. Does everybody have an umbrella policy? This is a liability, added liability that goes on top of your auto and your home. So when you got an apartment building or wherever it was in South Carolina, when everybody's dancing on the floor and suddenly the floor collapses, you guys see that this weekend or whatever? Let's say you're doing that at your house. That's probably not going to happen. But, you want to have an added liability policy. Let me use a better example. Let's say you run a stoplight, and you've got your regular auto limits. So if you have a lower policy, a lower limit policy, it's going to save you money. So you might have $100,000 max per person, $300,000 per accident. You can get higher than that. But so if you run a red light and you accidentally kill somebody that's 75 years old and just living on Social Security, that might be okay to cover your liability. But you kill a cardiac surgeon that's making $600,000 a year, your insurance companies, you're going to want your insurance company to go bat for you and have that added liability. So through Stu, that cost me $100 a year to have an extra $1 million of coverage on top of my auto and home. I mean, that makes sense to at least look at. Stu's going to owe me lunch.
I was just going to say, I'm
Yeah.
following him.
Determine your appropriate level of risk tolerance and adjust deductibles accordingly. A $250 deductible is going to be more expensive than a $500 deductible. So if you add that up over time, you're going to actually save the extra $250 just in insurance savings over probably 2 or 3 years. Life insurance, maybe 3 years. Life insurance. Oh, wait. What did I miss? Find out what records your insurance provider will want to see after an emergency. Meaning not after the emergency happened, but after an emergency, and store them in a safe place. So meaning you got a cottage up north, take pictures of what's inside there. Right? You probably heard that before. We use this example. I have a lady actually in Two Rivers that does have an antique unicorn collection. Take pictures of those things if they're worth money. You got a baseball card collection. Prove it. They've heard these stories hundreds of times. Make sure you actually have it documented. Life insurance. Make sure you have adequate coverage to pay for funeral costs, as well as replace your income. I mainly do investments, but when I look at life insurance for me, I've got a 10-year-old daughter. If something happens to me, I got $1.3 million of life insurance. Okay. Will I need that much life insurance after she's 18 and gone? Or let's say 25. Hopefully she's got a job and by that point. But I probably don't need to replace my income now once I don't have any dependents. So my life insurance need definitely goes down. But once I retire, now I got grandkids in the picture. Hopefully my kids are doing well to take care of my grandkids. But I may want to have life insurance to provide for the college education for the grandkids, or because I haven't saved enough money in my retirement plan to provide for me and my spouse and I, until age 95. So life insurance, long-term care insurance. This is huge. If you need to go to a nursing home, it's probably going to cost you $90,000 a year. Not now, but when you're in your 60s, 70s, and 80s. Is that $90,000 annual bill going to have a negative impact on your ability to have your retirement savings last you your whole life? Absolutely. So when you look at long-term care insurance, cost of care can significantly impact your retirement picture. Nursing home for Wisconsin, 2018 is about 90,000. So this is old. This is 2013 number. It's still about 90. Medicare only pays for short-term stays when leaving a hospital if you were in the hospital for 3 days prior. They'll cover that 20 days. Day 21 through 100, there's a big copay. I think it's like $161 a day that you're responsible for. Medicare isn't meant to take care of you if you're chronically ill, meaning you need help with 5 activities of daily living. It's meant to take care of your health insurance costs or a portion of your health insurance costs after age 65. Who was in Tim Gerke's presentation? Did they talk about Medicare at all? Social Security guy? No? That guy, that's a good one. So that's what Medicare looks at. So most seniors need to rely on Medicaid, which requires little or no assets. So what do I mean? Rely on Medicaid? You can't just have $200,000 in your 401k and then go to the nursing home and say, I want to leave this to my kids or my wife. So sorry, he or she needs to be taken care of, but I still want to come into this nursing home and have the federal government in the state of Wisconsin cover my care for that. It's not going to happen. So you're going to have to spend that money down first and then qualify for Medicaid, or you buy long-term care insurance. You don't want to buy it too young because they'll look at you, if I'm 25 years old, why am I buying the insurance? Something must be wrong. But 40s, 50s, you definitely want to look at that. It's getting more expensive every year. So that's what I say on. I've got a great contact. His name is Romeo Raby. Mel wrote that down, but it's Raabe. And he's got a website called The Long-Term Care Guy. It's The Long-Term Care Guy. This guy is amazing at what he does. He lives in Green Bay, Wisconsin. He writes the partnership plans for different states. He teaches continuing education to insurance salesmen or insurance agents to people across the country.
He's gonna owe you lunch too.
He's going to owe me lunch too. Well, maybe not. Actually, I probably owe him because he just sent me all the updated numbers. But so be aware of that long-term care insurance need. Short-term versus long-term disability. We talked about this. You guys have that available through the city of Appleton, right? Do they have short-term too? That's great. That's the one you're going to use, probably. I mean, statistically speaking. After 7 days or whatever the plan says. Before that, there's policies that have, it's just called sick pay. There might be, prior to 7 days, but I wouldn't have that as an employer. I mean, somebody gets sick all the time. It's very expensive to have anything with an elimination period of shorter than 7 days. So the short term typically covers until 180 days. Then you have your long-term disability. Why is that important? Well, younger individuals typically don't have 300, 400 grand in their 401k or a lot saved up. So if you do become disabled, and it's not a workman's comp claim, so you're at home, just trimming your shrubs and you cut off your thumb, you might not be able to operate the computer very well. So why is this important? Well, you might have family relying on you to pay for the bills. So what is the first thing you're going to use to bridge the gap until you're healthy again? Savings account. Most people ideally have 6 months in savings, but I don't have that much even. So savings isn't going to typically last until you're working again, if you're working again. Assets. If you want to tap into your 401k or your retirement plan, there's a limited amount that you can access. And you got to pay that back. So you can't just say, I'd like to borrow 50 from my 457B. Thank you. You got to pay that back weekly. It's going to be hard if you don't have a paycheck coming in to pay that. Loans. Most financial institutions aren't going to give you a loan if you're not working. That's the first thing they ask. What's your income? Well, I don't have any. I'm not working right now. Family. Can you live with a brother or sister, or can you help? Who's going to help you? I mean, sometimes you may be able to move in with parents, but do you really want to move the whole family in there? Social Security, they're going to talk about it down here. That's probably going to be denied on your first claim. You have to be physically, or it says right here, Social Security disability insurance. You must be completely and permanently disabled, not expected to work again to get accepted. And then those claims will last at least 6 months. So it's so important. That's the biggest thing being young. It's great that you guys have disability. I mean, that's huge. So if you want to move on to the next one. Am I running out of time? Yeah. Start or increase your 401k contributions. In your situation, 457B, or your spouse may have a 401k. They might have a 401k where they've got a match. Again, nothing against the city of Appleton, but I'm going where the match is. So if cash is tight and you only can do one of the plans and your spouse has a match through their employer, don't participate in this one, participate where the match is because that's free money. Contribute, it says it right there. Contribute to get the full match. If married, make sure your spouse contributes as well. Well, that'd be as if you're with the same employer, but they can do a spousal IRA. Compare your contribution levels to your retirement goals. I know I've got it on my website. I bet you guys do through Voya. Voya is a great company. You can go on the website and track your goals. If I'm sticking this much away and getting this amount of return, and I've got 20 years before I'm going to retire, this is what I'm going to have available, and this is how much income it's going to replace. Go on the website and look at it. Loans may be available in times of financial emergencies, but don't do them if you don't have to. Resist taking 401k loans unless absolutely necessary. Never take a 401k loan withdrawal prior to retirement. That is saying not a loan, but if you actually take a withdrawal, it's going to be taxable. So what happens is you get ding-donged on income taxes for federal and state. So federal, probably 22% tax bracket, state 6, so that's 28. The federal penalty, if you're under 59 and a half, is 10%. So that goes to 38. 3% for 3.33 is the state of Wisconsin penalty, so you're over 40%. So I always ask people, taking withdrawal, would you pay a 40% interest rate to buy this new motorcycle? Probably not. If the bank said, we'll give you this loan, we're going to charge you 40%. No. But I can get it out of my retirement plan, or I can get it out of my IRA. It's the same thing. If you're subject to penalties, don't do it. Okay, we'll go on to the next one. Summary. Preparation can help you avoid financial disaster. Budget to put yourself in control. An emergency fund can provide peace of mind. Reducing debt leads to financial freedom. Good credit makes life easier. I think that's a good point that we talked about. Insurance reduces risk exposure. That long-term disability is worth its weight in gold. And saving is a recipe for success. So don't procrastinate. So this little saying here, what does it say? Hope for the best, but prepare for the worst. Obviously, you probably heard that before. Here's where that, this is a presentation that has these different websites. So somebody was asking about a financial calculator. Dinkytown. My website has it, but this Dinkytown, they've got financial calculators. This mint.com, and again, this is in your packets. Helps with a personal finance website. You can go through this. I would look at ssa.gov. There was a gentleman in this last presentation. Social Security doesn't give you statements anymore. They don't mail them to you anymore. So they used to, 3 months before your birthday, you get your Social Security statement. They stopped doing that. About two or 3 years ago, they started doing it again if you're 60 or older. But if you're not, go on there, look at your earnings history. Social Security will base your primary insurance amount, or the amount you get from Social Security, on your 35 years highest wages. Go in there. Whoa, I better check that. Well, in 2015, they have me earning $7,000. I had $70,000 of income. You're going to want to make sure that that's accurate. And then the longtermcare.gov, I would go to Romeo before anything. Go ahead.
So kind of like the mint.com, I learned actually this morning too, if anyone attended the Voya sessions. Voya, on their website, you can actually input all of your bank accounts and everything, so you can actually track all of your expenses and everything on Voya. So it's just like mint.com, except it's through what we use, through our financial company. So she actually I have a packet that explains how you can track your budget and everything on Voya. So personal financial dashboard. So it's just like it's just like mint.com. You're tracking all of your expenses, you can budget and everything. So if you guys haven't gone to Voya or aren't planning on it, I would suggest even just going up and grabbing one of these.
That's not in their packets? No.
She handed it out at the...
I would go to Voya anyway, just because you have the relationship. It's probably better than mint.com.
Yeah, you have the relationship, you have the security of Voya, so even just pop over there, ask Julie for one of these. It's a really great resource. So.
Personal tracking.
Yeah. Did I miss anything, Vicki? I'm trying to think. Oh, are you gonna pass out the evaluations?
And then just this last
Oh, what's this last one?
guidance.
Oh, there is an additional resource. This is the last page. Guidanceresources.com. So then that's it. So she's going to hand out the evaluation. Thanks again for your time. We appreciate it. And thanks for allowing me to be here.